Right, we have reached to the very last session of the. Oh, this chair is covered. The very last session of the day for this series. With this we will be done with IFRS training program. So, financial instruments. Before I go to slides, I would like to, Habibi.
Assalamu alaikum. What is it? Can you just see that? Maybe.
Financial instruments. Already there. But exam, you need to see me behind the office.
Oh my God.
And then pay me some money.
Mother table,
Correct? Huh? See, financial instruments. Now, if you see a balance sheet, or statements of financial position, we have assets.
Oh, yeah. They pass on the
The total, when you see a balance sheet, one side is the assets, the other side is the equity and liability. Now, when you analyze the assets, as we know, we categorize into two headings. We have non-current assets and current assets. And when you analyze this equity and liability, that also we can analyze into three different headings. One is equity, one is non-current liability, other one is current liability. Now, of the items what we see here, now these assets, from a different perspective, we can describe as financial assets and non-financial assets. For example, if you have a motor vehicle, that motor vehicle is a non-financial asset. Financial assets are, in a different way we could say that monetary assets. Those assets you could convert them into cash in a short span of time. Like as I told you, motor vehicle, if you to sell, you may have to wait for 2 months, 3 months, 5 months, 6 months. Or if you to convert an inventory, same story. In other words, those non-current assets and some current assets will fall into this heading. Under non-current asset, one major section will come as investments. So these investments are can be known as financial assets. Why we have investments? In order to generate certain profits. So that helping us generating or producing earnings or income, and that falls into the category of financial assets. As I go down, we have the current assets here. Under current assets, cash, one example of financial assets. Receivables, also a financial assets. You continuously working with the customers and you invoice them and you collect them. But the struggle of how you manage your collection is a matter of routine activity and it's a matter of the company's policy. So, and as you go down, you have equity. Now, definition of equity is the residual interest from the total assets after subtracting all liabilities or all obligations or all outstandings. So, as you remember, our very first accounting equation is asset is equal to equity plus liability. And then what you do? Assets minus liability becomes equity. So that is the residual interest. What is the remainder? The remainder goes to shareholders or the owners or the founders of the company that you define them as equity. Clear? And among this, so on the asset side we have financial assets. On the liability side we have something called financial liabilities. There are non-financial liabilities also. Now trade creditors is an example of a non-financial liability which does not demand any cost of borrowing. When such liabilities are not resulting into any cost of borrowing on the outset or even effectively. There is a mechanism called effective cost of borrowing. So, depending on the way you arrange the agreement, that may change. But very simple example, trade creditors and accrued expenses will not fall into the category of financial liabilities. Then, now what are financial instruments? Is an agreement. Is an agreement which results between two or more parties which results a financial assets to one party and financial liability or equity to other parties. So this is what the literal write-up of the meaning of financial instruments. Meaning, you will end up an agreement. You will sign up a contract. When I say sign up a contract, does not necessarily mean that you are signing a contract in paper. In effect, you may have end up in a contract. This contract will result, and we all understand, any contract minimum we have two parties, sometimes three, sometimes four, but at minimum two parties. So, because of the outcome of this contract, the one party will have financial asset. The other party will have either a financial liability or an equity or both. It could be both as well. Simple example, I buy shares. I invest to one company, let's say not me, one corporate or one entity purchase 100,000 shares in entity B. Entity A purchased from entity B. Total share capital is 1 million. So for whom financial asset? Entity A or entity B? Now, entity A invest in entity B, purchasing 100,000 number of shares, each share $10. So, in whose books or in which party becomes holder of financial asset? B or A?
Who's saying
Please raise your hand with a show of hands. A.
B?
B is Mr. Mansoor.
Only B is also?
Hmm.
You also B?
Yeah.
Okay. Only also B.
So what shall we do now?
Kill him.
Kill him? Who said that kill him?
Masood.
Mansoor itself said that kill him?
Why is so pointless?
Yes. Actually, for Mr. A, it's a financial asset because he is investing.
Yes.
If you think about the double entry, he is paying by bank, example. So you need to credit the bank account. So he then have to debit somewhere. So when you debit such thing, we know that assets are always debited. So it's a financial asset for entity A. Whereas on the books of B, they issuing shares. So the number of shares in B increases. So then if you think the double entry for the books of B, they are receiving money in their bank, example. So you need to debit the bank account. Where shall I go and credit this?
Good.
Share capital. So share capital is example of equity. So equity is one example of financial instruments. Not financial liability, financial instrument. So in this transaction, you have any agreement will result into a financial asset and a financial liability. Another example, you go to a bank and get 8% convertible loan for 3 years. I receive a loan from the bank. I'm entity A, bank, let's say bank X, example. 1 million I have received. Now tell me, this is another example of financial instrument. Now the question is, in whose books this is a financial asset and in whose books this is a financial liability and or equity?
Bank is the asset.
In bank's books,
Asset.
asset. In the company A,
Liability.
it's a
Liability.
liability. Later we will talk about hybrid finance instruments or compound finance instrument. What is going to happen? On the outside we will see that it's a liability. But when you really go and work out and calculate, there is a hidden element of equity will fall in place. We will try to understand that later. Now, applicable standards. Applicable standards are actually what has happened, this is standards, this is presentation and disclosure, this is recognition, and now even more in most of the times, even in the examination point of view as well, mostly we use 9, not so. See, when you talk about any item in your financial statement, we have certain what do you call that, financial statement assertions. Heard of this word? In simple, I would say qualities. Any item you will see in the financial statement, that item must have certain quality to sit inside the financial statement. Now, if I want to show motor vehicle in my financial statement, motor vehicle goes and sit under non-current assets, under tangible fixed asset, or under property, plant and equipment. For me to say, okay, this motor vehicle I will show under property, plant and equipment, then that I should be able to measure it. Measurement. How much? I should also able to recognize the availability of the existence, the availability of the asset, whether such motor vehicle is in fact there. You know, company can say, okay, I have 105 motor vehicles in my business. You go and open MOI website and see, mashallah, nothing. So you have to make sure measurement, existence. Also, recognition comes to income statement. We'll come to that in a bit different example. Presentation. How I present? Motor vehicle, part of the property, plant and equipment note. I should present, I should show the cost separately. I also should show the accumulated depreciation separately. And in the cost, if I have any addition, I should show them. And under depreciation or accumulated depreciation, I should also show the current year depreciation calculation. Some additional aspect also might pop in. Suppose you dispose a motor vehicle, then how are you going to show? Or you revalue something, how are you going to show? So all these are qualities of financial statement, which the professional term is financial statement assessment. There are 7 different financial statement assessments are there. This aspect I'm not going to discuss because this will then take me to auditing. So we don't want to talk about that. Now coming to financial instruments, so this one is standard here that talks about presentation and disclosure. The other section of the standard will talk about recognition and measurement. So this is the general classification of those standards, and this is the basics with regard to financial instruments. So we will go into talk about the definition, classes of financial instruments, measurement of financial assets, and then we based on the new standard, how I measure. So also they come up with different models. Business model test, or different tests, in other words. Business model test, cash flow test, and if any of the financial instruments or financial assets to be impaired, how we do that, and classification and reclassification of financial assets and de-recognition of financial assets. And that is all about financial assets. Then we have financial liabilities, measurement of financial liabilities, impairment of financial liabilities, reclassification of financial liabilities, de-recognition of financial liabilities, then business model and cash flow test, impairment of financial instrument, and also something called derivative. As I said in the last session, when I introduced financial instrument, I myself said it's one of the most complex topics in the entire financial reporting, financial practice. a means of raising finance and includes everyday loan. In a simple means, for you to say that what is a financial instrument, it's a means of raising finance. Both parties. One is giving, other one is receiving. So in practice, wide-ranging, extremely complex financial arrangements like hybrid financial liabilities or embedded loan. You will read these in different magazines, articles, sometime in audited financial statements. You will come across this. Separate standards dealing with how financial instruments should be presented, recognized, measured, and disclosed. See, these are the standards: IFRS 9, IAS 32, IFRS 7, IAS 39 actually that is replaced. So these are the 4 standards, as I said just now. Now IFRS 9 is the superseding version of IAS 39. You understood that mechanism? So there is no more 39. Instead, IFRS 9 has come. Is that clear? A contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. I would like to add another letter here: financial liability and or equity. I hope you all know the meaning of that, adding the phrase and. $13,000 Sir, lecture on sir, time oh, no problem. Okay. Right on that. Okay. So, as we said, to outcome from the one contract, one is a financial asset. Example, a cash, an equity instrument of another entity. A contractual right to receive cash or another financial asset from another entity. Sometimes you don't have cash, but you have a contract. The contract gives rise to receive a financial asset from another entity. To exchange financial asset or financial liability with another entity under the conditions that are potentially favorable to the entity. This word is very important. Now, you signing a contract. Because of you signing a contract, if you are in the side of the potentially favorable, then in your books you recognize financial asset. If the same other side, if you see the opposite of it, potentially unfavorable, will become financial liability. Clear? A contract that will or may be settled in the entity's own equity instruments and is a non-derivative, later we talk about it, for which the entity is or may be obliged to receive variable number of entities on equity instrument. Let me give you a simple example for this. You sign a contract. This contract will or may be settled in the entity's own equity. Now I have shares. I have shares in my company. I am signing a contract with you to undertake certain activity and I need to pay you. I am not paying by cash, but I am settling through some of my shares. And is a non-derivative. We will come to this non-derivative discussion derivative discussion little later, for which the entity is or may be obliged to receive variable number of entities on equity instruments. Or it could be a derivative as well. Derivatives are the next level in the financial instruments. options, features, swaps, this type. I don't want to go into that discussion, I believe. Because if the calculation, I don't want to do it. So, a derivative that will or may be settled other than by the exchange of a fixed amount of cash, or another financial asset for a fixed number of entities on equity. To keep this very simple for these two paragraphs, I am signing a contract with any other entity. How I receive, so let's say I am agreeing to perform a service, $5 million, suppose. So they say that, okay, we will give you, instead of cash, we will give you our shares. So I have the right to receive the financial instrument of that other entity. So in favor to my books. So that becomes a financial asset. Whether each of the following meet the definition of a financial instrument: issue of ordinary share capital, issue of debt, sale of goods on credit, that also possible, purchase of goods on credit. Issue of ordinary share capital represents an entity instrument since the shareholders own a financial asset and the company has an equity instrument in the form of new share capital. Hope it's clear. Issue of debt, same story. I don't want to go into very detailed reading of this. I will share the material. Good morning. Yeah. Okay, I'm sending now. Thank you. Yeah. So it's whether it is a share capital or equity instrument, whether it is a debt, all of this, or sale of goods on credit. Now, when you sometime, I don't know, at your school days or university days, you study something called bill of exchange. Study bill of exchange, promissory note.
Studied or not? Yes or no?
Hello.
Promise or broken notes?
Somebody is helping me processing a visa. He is asking one image from the class.
Egypt shop visa?
Come with me. Okay, when you meet me behind the building,
Yes.
he told me he need certificate today. I said, okay, I can give you, but see me at the back side of the building.
In the car.
Within
In the car, better.
Within 1,000.
Yes. Within 1,000? No problem. Mashallah, 1,000 is good for me. Yes. This is a photo. This is a photo. Outline को. Let's disable that.
No, you can normal, no problem. Scan, screenshot from the touch
No, this app doesn't allow.
Your mobile not.
My own
Problem in your mobile, not
very old mobile, Samsung S20 Ultra.
only everybody can text.
No.
You can make share for another thing person and he can make the.
Somebody is seriously trying to help me to bring some of my nephews to Qatar for the East. Okay, so bills. So what is this bills? Promissory note. Heard of these terms?
Yes. For them in college. We make payment easily.
So exactly. So if you happen to have a credit transaction and then you agree to execute certain commitments or certain promises instead of paying by cash.
Yes.
So that is another example of financial instruments. Financial instrument should be classified as either an equity or an instrument or a financial liability according to the substance of the contract. We talked about substance over form. When you read a contract from the outside, that may give you a different meaning. But if you really see the substance of that, that will have another different meaning. An entity must make this decision at the time the instrument is initially recognized, and classification cannot be subsequently revised based on changed circumstances. At the beginning, how you decide, on that basis, you should work on it. I started to state that complex financial instruments should be classified as equity and liability. Equity instrument or financial liability. A financial instrument is an equity instrument only if, see these terms, the instrument includes no contractual obligation to deliver cash or another financial asset to another entity. See, if I have capital, I hold the share capital, and then I have no obligation to satisfy another condition with someone else. My own capital. So that is what? Equity instrument. If the instrument will or may be settled in the issuer's own equity instrument, it is either a non-derivative that includes contractual obligation for the issuer to deliver a variable return. What is a variable return? Dividends. I hold shares and then I receive what? Dividend. What do you mean by hold? I pay cash and get some shares. My variable returns are what? Dividends. Is the ordinary dividend fixed? It's not fixed. Year to year it's variable.
Yes.
It's based on the management decision. A derivative that will be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of. So in other words, capital transaction. When you settle your share capital or shares, you receive some other equal amount of equity instrument. So this is equity instrument. Now compound financial instrument. That's what I said. This is both. If you read that contract will have a liability portion and an equity portion. But on the outset, you don't see that. Component parts must be accounted for and presented separately according to their what? Their substance. Split made at issuance and cannot be revised. So this is both liability and equity. Measurement of financial asset. IFRS 9 encourages use of fair value. Although organization can use amortized cost if they can pass two basic tests. Normally you should use what method? Fair value method. Ignoring all the complexities, what is fair value? The open market value. Okay? Now, at the time when I am doing my exams, that much understanding is not there. So then, how to come over is to keep the things simple and basic. Very difficult to remember the entire 4 or 5 lines definition of fair value. At the measurement date, in the open market, participants, availability, so many blah blahs running around the head. Instead, the market value that you find anywhere, you go to shop, how much is this bread? 4 years, that's a market value, class. So, that is how, if you want to, you see, normally, these financial assets or financial instruments should be measured using fair value. But if you insist, if you instill, you want to use alternative or what you call amortized cost method, that you can do only if it successfully passing the following 2 tests. What are those tests? Cash flow tests. You should check and confirm that financial instrument will successfully produce a confirmed cash. And what is the business model test? Must be probable that organization will hold financial instrument till maturity. Financial instruments are not purchased with intention of resales. If the cash flow test is, it must be probable that organization will receive all the principal and attributed interest attached to the financial instrument at its expiration. Now, before these standards developed, these investments are divided into 4. One is held to maturity, meaning you purchase a land, you keep it there, let it be. That I have no intention of selling now. I will keep it, then I will transfer to my son, he will keep it, he will transfer to his son or daughter, and it goes on like this. But if it is an entity, a corporate, they will keep it for next 50 years. So next one, held to trading. You keep it and for certain period of time, what you do is that you trade. This is second method. Third one is what you call that for the sale purpose. Buying and sale. It's like your shares in the market. Currently, after the standards updated and revised, they changed this. They said that you keep your financial instruments either to recognize your outcome through fair value, through profit and loss. And as we all know, under IAS 1, when I prepare my income statement, I have 2 sections. Profit and loss section and other comprehensive income section. When I say fair value through profit and loss, the outcome of that, see last year, December 31st, 2022, 100 million. December 31st, 2023, 108 million. So I have 8 million gain or fair value here, increase. This 8, you should show it where? In your profit and loss account. But if you remember IAS 16, when you do a fair value, and you have a valuation surplus, you are not taking to profit and loss, you are taking to other comprehensive income. So, in accordance with IFRS 9, financial assets must be classified under the following 3 headings. Financial assets measured at fair value through profit and loss, financial assets measured at fair value through other comprehensive income, and financial assets measured at amortized cost. Classification is made at the time of financial asset is initially recognized, namely when the entity becomes a party to the contractual provision of the instrument. So at that time you decide how I'm going to recognize this. Initially measured at fair value. See, I'm talking about financial assets measured at fair value through profit and loss. So we measure the financial instrument at fair value with transaction cost being expensed. Yeah. So, financial assets measured, so it should be at the, what do you mean by transaction cost? See, sometimes you sign a contract, then you hire a lawyer, then you need to pay the lawyer's cost, or stamp duty, or government fees. So these are transaction costs. If you measuring your financial assets using fair value through profit and loss, and that transaction cost you should consider as expense. After deducting the transaction cost, remaining only you will recognize financial assets. See, and every year you have to do your fair value calculation, and the difference you will take it to profit and loss. I hope you understood that, what I am saying. Now, 1 January 2020, 100, 31st December 2020, 109. So this different 9, you will take it to profit and loss account. That's what I am saying. Now, your cost of the investment is 100, and you have paid, cost is 100, and you paid other expenses, so transaction cost is 5. So total 105. But this 5, you will take it to profit and loss account. And this 100 only, you will recognize as an asset. Financial asset held for trading purposes. Derivatives, unless they are part of properly designated hedging arrangements, and debt instruments, unless they have been correctly designated to be measured at amortized cost. These 3 examples will fall under the category of financial asset measured at fair value through profit and loss. The measurement of fair value takes place at each reporting date, with any movement in fair value taken to profit or loss in the year, which effectively incorporates an annual impairment. Sometimes we cannot expect the value to increase, but it can also decrease. So either side you take it to profit and loss. So the second scenario is amortized cost. Amortized cost is the cost of an asset or liability adjusted to achieve a constant effective interest rate over the life of the asset or liability. What do you mean by effective interest rate? Nominal, we have 2 interest rates. One is nominal interest rate, other one is effective interest rate. Let's say I have a loan, 1 million, and the bank expects you to pay 7%. Every quarter you need to pay interest. So how much is the interest? Annual interest will be 70,000, right?
Yes.
So this 70,000 you need to pay every quarter. So that means 17,500, correct? So this is based on your nominal interest rate. But there is also something called effective interest rate. What is effective interest rate is the opportunity cost of holding this loan or giving this loan, and what would be the effective cost of borrowing because of this. If you instead giving the loan to someone, if you instead deposited somewhere, what would be the best earning you would be foregoing? And that is what the effective interest rate is. And so, based on effective interest rate only, we calculate the amortized cost. Amortized cost calculation is nothing but calculating the present value over the several periods. Suppose the loan is for 4 years, so that means how many months?
And for 48.
48 months. So for over these 48 months, and every month we are going to receive, you see, I am going to receive principal and interest. And the total we call it installment. Am I right? And as the time pass by, as the progress, what is going to increase and what is going to decrease?
Interest increase.
Interest will increase, installment will decrease. But the installment is remaining the same. So this calculation all we do based on effective interest rate. Financial assets that are not credited fair value to the profit and loss. Example, those credited amortized costs are subject to an annual, even though you are measuring the financial assets using amortized cost. You are not doing a fair value, but still you are obliged to find out what you call the impairment. You go to perform an impairment test. The financial asset measured at amortized cost classification applies only to debt instruments, you see, and must be designated upon initial recognition. In this instance, financial assets are initially measured at fair value plus transaction cost. In the fair value through profit and loss, what is the difference? The transaction cost we will not take into the value of that asset. You will recognize, you will expense it. But here you will put that also into the profit. A debt instrument that meets the following two tests may be measured at amortized cost. One is business model test, other one is the cash flow characteristics test. A debt instrument meets the following two tests may be measured at amortized cost net of any write down for impairment. Why they say that? Because at the end of any year, if because of the impairment test, if the value falls down, the difference you need to write off. Except that, you got to do the way of amortized cost, and you should satisfy these two tests: business model test and cash flow test. What do you mean by cash flow test? You will receive principal and you will receive interest over the maturity period. And what is business model test? What was the purpose of this particular debt is given and generating interest income. That's my purpose. So you satisfying these two conditions. Reclassification of financial asset. Financial asset reclassification is required between fair value through profit and loss to amortized cost or vice versa. Possible, no? So if I already decided FVTPL, later I'm saying no, I need to transfer to amortized cost. If the entity's business model objective for its financial asset changes, so that its previous model assessment no longer applies. If reclassification is appropriate, it must be done prospectively. What do you mean by? Now there are two terms we discussed: retrospective and prospective. Prospective means today and the future. You don't need to go back and adjust anything. An entity does not restate any previously recognized gains or losses or interest. We don't need to worry about what has happened up to yesterday. You just need to continue from today and the future. IFRS 9 does not allow reclassification where, what is OCI? Other comprehensive income option has been exercised for financial asset, or fair value option has been exercised in any circumstances for a financial asset or a financial liability. Now, fair value through, we discussed about fair value through profit and loss. Now, what here we are saying is fair value through other comprehensive income. Suppose I have chosen any of the financial asset to recognize through fair value through other comprehensive income, then IFRS 9 does not allow reclassification. Also, fair value option has been exercised in any circumstances for a financial asset or a financial liability. Impairment. IFRS 9 effectively incorporates an impairment review. I believe all of you by now know the meaning of impairment. IAS 36. The recoverable amount, when the recoverable amount is less than the carrying amount, the difference is impairment. So here, under financial asset also, we need to do the same test. For financial assets that are measured at fair value, as any fall in fair value is taken to profit or loss or to other comprehensive income in the period, depending upon the classification of financial assets. For a financial asset designated to be measured at amortized cost, an entity must make an assessment at each reporting date whether there is an evidence of possible impairment. If impairment is identified, it is charged in arriving at profit or loss immediately. You got to transfer that amount direct to P&L. The recoverable amount would normally be based upon the present value of the expected future cash flows. Now, we talked about how you arrive recoverable amount. There are two methods. One we said economic use or fair value less cost to sell. So here what they say, the recoverable amount would be normally be based upon the present value of the expected future cash flow. This is economic use. Estimated at the date of impairment review and discounted to their present value based on the original, see, effective rate of, actually not rate of, rate of, some more. At the date of financial review was issued. IFRS 9 states that financial asset can be impaired only if the recoverable amount is less than. That is normal logic. If the expected future loss cannot be calculated for estimated reliability, therefore actual loss for the period must be recognized. If I am unable to recognize the future expected loss, then you got to see current, what is the actual loss. Then you do the calculation. And you, I don't know, you are doing this expected credit loss calculation in your receivables, ECL. Audit to see that. You are not doing it? So there is something called expected credit. You have your receivables.
Yes.
Normally what we understand that receivable, we prepare this provision, no? Aging.
Yeah.
Now those days aging calculation is what they do. 0 to 30,
Yes.
30 to 60, 60 to 90 like this. And then management will have a policy, any receivable after 180 days will charge 25%. Any receivable after 365 days will charge 50%. 2 years like that. That was the old school of thought in calculating provision for allowances or allowances for receivable. But now what they say, it's not like that. You got to arrive based on next several periods, this particular receivables discounted value. The difference in the discounted value is what you call expected credit loss. And that you recognize in your case. So, IFRS 9 prescribed 3 credit loss models as follows towards impairment of financial assets. 12-month credit loss model is applicable on financial assets where there is no significant risk attributed to the financial asset. This is where organization make a provision in line with prudency concept applying general provision to assets. Expected credit loss model, which I have discussed now, whole life credit loss model. So please go through this in detail when I am sharing the material. Once an entity has determined that the asset has been transferred, it then determines whether or not it has transferred substantially all of the fiscal rewards of ownership, obviously. That you need to. If substantially all the risk and rewards have been transferred, the asset is C. If I transfer all the risk and rewards of this asset to there, in my books, I can't keep that asset with me. So that's what we mean, de-recognize. If substantially all the risk and rewards has been retained, de-recognition asset is precluded. I can't de-recognize. Still, the risk and rewards are with me, I cannot de-recognize. If the entity has neither retained nor transferred substantially all of the risk and rewards of the asset, then the entity must assess whether it has relinquished control of the asset or not. If the entity does not control the asset, then de-recognition is appropriate. However, if the entity has retained control of the asset, then the entity continues to recognize asset to the extent to which it has continuing normal engagement. So, in simple, without going into the very detailed discussion of this, as long as you satisfy the condition that you transfer all the risk and rewards to the other party, you de-recognize, meaning remove that financial asset or liability from your books. Measurement of financial liabilities. Now, fair value through profit and loss and amortized cost. So, both ways. We discussed that in this one also. Includes financial liability held for trading and derivatives that are not part of hedging arrangements. All other financial liabilities are measured at amortized cost unless the fair value option is applied. Classification is made at the time of financial liability is initially recognized. Ifrs 9 requires gains and losses on financial liabilities designated as fair value through profit and loss and to be split into the amount of change in fair value that is attributable to change in credit risk. This is a detailed calculation. At this point of time, we don't need to worry about this. It's a very detailed calculation and we work out based on the credit risk. You know this credit rating index, A+, AA+ and all that. That rating is helping us to understand what level of risk that we have. The remaining amount of change in the fair value of liability, which is presented in arriving at profit or loss. So the total loss you will split into two. If it is related to the loss relating to the fair value of the credit risk, then you take it to other comprehensive income. All the remaining loss, you take it to profit and loss. If the accounting treatment for the credit risk creates or enlarges an accounting mismatch in profit and loss, then gain or loss relating to credit loss should be taken to profit and loss. If the accounting mismatch, if the calculation is not matching with our original contract, then you take where? Take it to profit and loss. This determination is made at initial recognition and is not reassessed. Amounts presented in other comprehensive income should not be subsequently transferred to profit and loss. Once you disclose in other comprehensive income, you cannot transfer to P&L. So, accounting treatment for the credit risk creates or enlarges an accounting mismatch that I discussed already. Amounts presented in other comprehensive income should not be. So we said that also. The same thing. What is offsetting? Offsetting is netting off. IAS 1 presentation of financial statement states that assets and liabilities and income and expenses should not be offset. Netted against each other. Receivable, payable, sales, commission, like this, unless required or permitted by another standard. IAS 32 specifies that the financial asset and the liability should be offset and the net amount reported when an enterprise currently has a legal enforceable right of set off. IAS 1 tells you you cannot offset, but IAS 32 says what? You can, provided it is both under the same legally enforceable right of set off. Intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. So in that case, a derecognition of financial liability. A financial liability should be removed from the statement of financial position when and only when it is extinguished. What do you mean by extinguished? Khalas. Mouth. That means totally gone out of our books. And is when the obligation is specified in the contract is either discharged or cancelled or expired. If I taken a loan, if I fully paid and settled, that is what I mean extinguished. Or halfway, I went and talked to the bank, I said that I cannot continue, I cancel the contract, extinguished. Or the contract is expired. In all this case, it is extinguished. Where there has been an exchange between the existing borrower and the lender of debt instrument with substantially different terms. See, I have an old loan, I am talking for a new loan. So then when I am taking the new loan, the old loan becomes extinguished. Again, orders from the extinguishment of the original financial liability is recognized in statement of profit and loss and other comprehensive income, meaning P&L. Hedge accounting. Hedge accounting actually, I don't want to go into detail. Why? It's that level of complication. So I'll just give you the examples of what are these. See, what happens is, let's say I have inventory. When I have inventory, let's say 10 million inventory, and then I'm unable to sell this, or sales will take place after 3 years or 4 years. Then what I do, I go and talk to a bank. Look, I have this much inventory. Can you finance this? So they will finance. I will have cash. So I have taken a loan against inventory, hedging my inventory. So later I will start selling the inventory and I will have an agreement with the bank at a given price. Whether I sold at a less price or more price, I need to settle at that price too. Another example, foreign currency. I purchase, let's say, British pounds. So I'm in my business time to time. I need British pounds. So I know that British pounds with the Qatari riyal exchange rate is always changing. In order to mitigate this risk, what I do, I go and tell the bank, look, you give me British pounds at 4.85 class. Whether it is 4.7 or 4.9, you fix it. And then I pay like this. Or also if I have foreign liabilities. So these are all is called different examples of hedge accounting. Please read this on your own personal time, and anyone in person need more detail, talk to me, because I don't want to complicate this topic more. So with this, I just want to conclude the session. I need Siraj back here, so that we can have a small collective discussion or feedback as to what has happened in this session, how useful, and what any improvements we have to do, like this. And then finally, I can give the certificates. I will call, but I think your name is there in the list?
Yeah.
If you are there, the certificate is there.
Today last day?
Khalas.
Finish?
Finish.
But there is another.
What is another?
Good.